Good morning, Traderfirstyear. This is the 4/26/2021 morning forecast. Markets are implying a move of 1.12% up or down on the S&P 500. Markets have realized a move of 0.77% up or down. The difference between what market makers are implying and what has been realized has increased. The spread widened to 560 basis points. The put-call gamma imbalance favors put buying relative to call buying. Short put gamma on client purchases has the potential to exacerbate market sell-offs. However, a widening spread increases left tail risk and the potential for spikes in realized volatility. Realized volatility has decreased recently below 13. This is favorable for smaller moves up or down on the indices. I expect a decreasing trend over the second quarter during April, May, and June. The current market environment is favorable for traders looking to sell convexity via short straddles, strangles, calls, overriding, put rights, and other short vol strategies to capture alpha. The MOVE index hovers around 60 to 65, or movement of 3 basis points daily in Treasury yields. However, economic growth, upgrades, and rising inflation expectations were pushing up real yields and raising discount rates. The rise in yields has diminished, lessening negative effects on long-term duration assets such as technology stocks and long-term bonds. The S&P is expected to move close to 1.27% up or down this week, which means the S&P could rise 16% or fall 13% above its 200-day moving average, which is 3,630.20. The S&P traded well above its 50-day moving average, which is 976.32. Full year S&P earnings are expected to total 176 per share. At current prices, this puts the S&P at 23 times earnings, which equates to an earnings yield of 4.3%, or an inflation-adjusted real yield of 1.86% using the 5-year TIPS break-even for inflation, which is currently at 2.44. Analysts are anticipating earnings in 2022 of 202 per share. At current prices, this puts the S&P forward earnings for 2022 at 20.3 times, or a yield equal to 4.9%, and an inflation-adjusted yield of 2.46%. Forecasters have upgraded nominal and real growth expectations for the full year. The highest number of private forecasters and those from the Federal Open Market Committee members are close to 7% on a real basis. If this rate of growth is realized, it would add $1.3 trillion of real output to the U.S. economy. The coronavirus subtracted 3.5% of real economic output from the U.S. economy in 2020. In 2021, the U.S. economy would need to grow at least 3.62% to break even on a real basis. For the first quarter of 2021, upgrades to current estimates of nominal growth of $550 billion and real economic output of $378 billion. There is no seasonal rigidity this year associated with first quarter growth. The Atlanta Federal Reserve GDP now indicates a first quarter growth rate of 8.3%. This equates to nominal growth of $563.8 billion and real growth of $389 billion. At the end of Q4 2020, the U.S. lost $500 billion in nominal growth and $669 billion in real growth. The U.S. will break even and eclipse this mark by May or June of this year, 2021. The U.S. is also on pace to close the output gap by the end of the third quarter, which means the economy will be running hot into the fourth quarter and first quarter of 2022. The U.S. is on pace to generate a little over $560 billion of nominal economic output in the first quarter. At current pace, if this held through the full year, would generate close to $2.2 trillion of economic output. While this is exciting, I do not think this pace is sustainable or likely to culminate in those size gains. However, I do believe a nominal gain of $1.5 trillion to $2.1 trillion in economic nominal output is possible in 2021. Full-year economic output estimates have been increased significantly following the passage of stimulus. The median forecast was anticipating close to $1.2 trillion in nominal growth and $800 billion in real economic output for 2021. The $90 trillion global economy will be led by the U.S. and China, contributing more than $1 trillion individually and $3 trillion combined to global output. Current account imbalances between surplus and deficit countries are likely to persist. However, they represent only 1.25% to 1.5% of nominal global output. These imbalances relative to the buildup before the great financial crisis are significantly smaller. Current account surplus ranges between $1.6 trillion and $1.9 trillion, and global current account deficits mirror these amounts. The large creditor nation's saving surplus will allow the U.S. to run very large fiscal deficits. A major acceleration in growth is positioning the U.S. to capture more than one-third of global economic output in 2021. Economists continue to place the highest expectations for growth in the second quarter of 2021. U.S. households and businesses will add a substantial amount of spending on goods and services, which may face downside risk if there are any delays in COVID vaccinations, rollouts, or any unforeseen supply chain bottlenecks. Personal consumption expenditure in April, May, and June will likely range between $80 to $160 billion per month. We could see nominal GDP in the second quarter of $700 billion to $600 billion, and real output between $375 to $310 billion. In addition to spending more in dollar terms, U.S. households will also be saving more. A prolonged higher U.S. savings rate relative to historic norms will help fund larger DIS savings in the public sector, which along with Federal Reserve large-scale asset purchases will somewhat mitigate substantial reliance on foreigner savings. The March non-farm payroll report was extremely robust, changing the recent overall trend, which had been tilted towards weaker payroll growth. Despite a stronger report, there still exists 10 million Americans unemployed, a larger cohort of more than 4 million on longer-term unemployment, and 20 million receiving some form of unemployment assistance. A return to 164 million U.S. workers employed may be continually undermined by the 6.5 million Americans remaining out of the labor force, which indicates large and substantial slack in the labor market. Private forecast is anticipating payroll growth between 270,000 and 500,000 per month, which equates to 3.2 million and 6 million additions to full-year U.S. payrolls. This key economic indicator is likely to pressure growth in the first half of 2021. The relatively slow growth of the U.S. population, along with a substantial rise in the number of workers not in the labor force, has shrunk the size of the currently available labor pool. In 2020, the U.S. lost a total of 9.7 million jobs, or a loss of 6%. To break even this year, the U.S. would need employment growth of 6.6%. Nominal wage gains topped 5% during the recession for non-supervisory workers. Although ECI, Employment Cost Index, salary and wages rose 2.8% in 2020. The gain in productivity, employment compensation, and a large amount of slack in the labor market tilt towards a continuation of non-inflationary pressures as the U.S. economy grows. However, the recent agreement on $1.9 trillion in deficit spending is a significant tailwind to nominal growth in the second half of 2021 and the first half of 2022. This should increase aggregate demand, which should foster higher employment gains, but this assumes that virus cases come down substantially by April, May, June, and pandemic flare-ups lessen. This has led some market observers to anticipate economic overheating, which is favorable for upside risk in inflation. I believe these fears are statistically unfounded. However, I do not disagree with rising inflation as a potential risk in the short term. The recent increase in nominal Treasury yields and 5-year break-evens on TIPS, which are Treasury inflation-protected securities, towards 2.44% is transitory and likely reflecting anticipated increases in energy prices and base effects. The Federal Reserve typically subtracts 40 basis points from the break-even inflation rates, which would mean inflation expectations are currently anchored around 2% of the inflation averaging metric. Following the passage of stimulus, larger fiscal DIS savings increases capital inflows to finance very large twin deficits, which should put upward pressure on the U.S. dollar and downward pressure on corporate and government bond yields. The most recent trade data indicates the U.S. is on pace to record a real trade deficit of $1.2 trillion by the end of 2021. The current rise in yields and increase in growth expectations will likely favor a stronger U.S. dollar in the first half of 2021. This is also likely to put additional pressure on higher real yields if growth and inflation increases are realized. Although potentially weaker inflation data than consensus estimates should allow real yields to remain deeply negative, thus providing additional support to the Federal Reserve's ZIRP, which is the zero interest rate policy, and an extremely accommodating stance. Dollar appreciation also dampens import commodity-driven inflation and should lessen temporary transitory base effects. The strong U.S. dollar may have negative effects on emerging market countries with large current account deficits and substantial debt denominated in U.S. dollars. Inflationistas and inflation fear mongers engaging in scare tactics are likely to be proven wrong. However, inflation base effects are expected to be short-term. There will be transitory spikes in headline inflation data from April, May, and June. The impact on core PCE is expected to be limited. Market expectations are split, but I expect the Federal Reserve will look through these spikes. Political risks have diminished in the first half of 2021 due to reconciliation, but it has increased in the second half of 2021 and likely in the first half of 2022, which may pose risks to much needed investment spending on infrastructure, human capital, and research and development. So I view it in the medium term as tilted to the upside due to potential gridlock. However, there is the possibility for another round of reconciliation in the 2022 budget, combined with the removal of the filibuster rules in the Senate. This could pave the way for easier passage of investments-led spending, which is much needed to raise the U.S. long-term potential growth rate. Although, due to political isolation, this increases the potential for lone wolf domestic terrorism. Vaccine distribution is priced into Q3 2021, but distribution obstacles have increased and efficacy for herd immunity will be closely watched. Redefining herd immunity may become the norm, so instead of a fully vaccinated population of 90%, we may accept a different goalpost for full vaccination. Perhaps it drops between 70 to 75%. Details are currently unknown. The market is currently pricing in an additional 4.82% move up or down by June 18th. The S&P could potentially trade as high as 4,367.95 and as low as 3,975.48 by June 18th. The VIX is expected to move 6.81%. The VIX is currently at 17.96. The VIX price range is 19.18 to 16.81. The skew index is elevated, which indicates market participants are paying up for catastrophic protection. Those are two sigma events. Stocks continue to offer investors the highest real returns. The nominal yield on equities is 4.3%, while the nominal yield on 10-year treasuries is 1.58%. Real yields on all tenors of government bonds at the shorter end and belly of the curve are decisively negative, but real yields at the longer tenors above 30 remain slightly in positive territory. Real yields on U.S. equities remain strongly positive. Disclaimer: with realized volatility near 12, there is a larger risk of systematic, highly leveraged short vol strategies like equity vol targeting, trend following, and risk parity, positioned for a massive increase in market exposure. The potential for a much higher move has increased, while a large sell-off has decreased. We are much more likely to see a fall in realized and implied volatility and a gradual melt-up in asset prices. The May-June VIX contracts at 20 and 22 are fairly priced. In fact, they may be overpriced given the new economic outlook. Passage of fiscal stimulus should juice the start of the new long-term economic cycle, which favors continued falls in realized volatility. I am temporarily moving against a large rise in implied and realized volatility. However, I've been wrong before, but the sell-offs will give investors great opportunities to buy the dip. Traders should focus on cyclical sectors which tend to outperform at the start of a new economic cycle. For example, being long financials, industrials, metals, mining, oil and gas, and consumer discretionary and technology. Anyway, good luck and have fun trading this week.